Hello everyone. Thank you very much for joining us. I would like to welcome you to our free tax planning webinar for small businesses. This is just one webinar of a series of webinars we are putting together purely for educational purposes. Some of our free webinars are related to retirement planning, payroll services, the Affordable Care Act, and QuickBooks. If you are interested in those webinars, please go to our website, www.mbecpa.com/business-webinars to really view the content and dates available for those webinars. Also, if you are interested in learning more about a specific topic, please just let us know. I am Kevin Block, a certified public accountant, and I work with MBE CPAs out of the Sun Prairie location. A little about myself. I have been in the public accounting industry for over 5 years, and my primary focus is on small businesses, ranging from businesses in the agricultural industry to businesses in the manufacturing and retail industries. I have also focused on the Affordable Care Act and how it affects individuals and businesses. I would also like to introduce a member of my team, Javier Perez. Javier, can you tell us briefly a little about yourself?
Hello everyone, my name is Javier Perez. Thank you for joining us today. I am a staff accountant here at MBE CPAs. I work on the individual side of tax at the Sun Prairie location. I've been in individual tax for over 6 years, and I work closely with clients for planning during the year.
And just if anybody wants the handouts, they are available. So all you have to do is click on it. It's a PDF file. You can still have the handouts as well. So, all right. Here is an outline of what we will cover during our webinar. Javier will cover what MBE CPAs is and what we do. He will also briefly introduce some divisions of MBE CPAs and how we can assist you in other capacities you may not already be aware of. Then we will go over the different types of business taxes out there and what tax planning is, why you should do it, when you should do it, how you can prepare for a tax plan, how we can help you through the process, and then get into some strategies of the tax planning process with some examples. If you do have any questions, please feel free to type them into our comment box. We plan on checking that throughout the presentation. Our presentation is pretty limited since we really can't tailor to a specific situation. There's just a lot of situations out there. It just makes sense. If you do have a specific question or something that you'd like answered, just go ahead and type it into the comment box, and we can definitely address that during the presentation. So, Javier?
Okay, well, MBE CPAs. What is MBE CPA? What do we do? Well, MBE is a CPA firm that started back in 2001 with an office in Baraboo, Wisconsin, and has grown over the years to be a very successful community-oriented business. We now have 7 locations throughout Wisconsin. So we have offices in Baraboo, Wisconsin Dells, Rittsburg, Tomah, Wausau, Marston, and Sun Prairie. We recently have opened a satellite office in Lake Mills, in which here Kevin is the one in charge of that satellite office, and we are very excited about it. We just started that project, and it's something that we really like to share with people. We offer a broad variety of accounting-related services, such as tax preparation and planning for individuals and businesses as well. We have many clients in a variety of industries, and we have the expertise of doing any business tax return in really any industry, whether it may be farming, agriculture, retail, manufacturing, the restaurant industry, really any industry, and even consulting. We have a client for each kind of industry there's out there. So we have the expertise. We are pretty confident we can tackle any task. We also provide bookkeeping services. Where we can be, as involved as you want us to be. We can do all the bookkeeping for you, or we can just review the bookkeeping after you or an internal accountant that has prepared them for you has done it. We can review that, or we can train you on the software and basics of bookkeeping with software like QuickBooks. We are QuickBooks Pro Advisors. We're certified, so we can also do that. We also provide test services such as compilations, full disclosure compilations, reviewed financials, and audit. We also provide a business consulting and business valuations. We are going to talk about the divisions of MBE CPAs. MBE CPA is not just limited to a CPA's office. We also have a division which is called MBE Wealth Management, which is an LLB certified advisor brand. And at MBE Wealth, we help our clients plan for retirement, establish investment accounts, as well as life insurance, and we also provide financial planning for businesses interested in accessing how they can improve their business. Another division of MBE CPAs is Payroll Solutions, which specializes in live and after-the-fact payroll, quarterly and annual filings, and ACA consulting, which is the Affordable Care Act / Obamacare. For a lot of our clients, they actually value the fact that MBE CPAs has a wealth management division so that they can have their investment advisor have a more open communication with their tax professional, when making very important investment decisions that may have heavy tax implications. It's really good for our clients. It really gives them that peace of mind that the guy that's managing their wealth and their finances is also working with their accountant, with their CPA, and they know that there's not going to be miscommunication there, that they're actually working with the same purpose, which is helping the client. That's actually a huge benefit of having all your finances and your tax affairs under one roof. Clients also value the payroll services Payroll Solutions provides, so that they don't have to worry about quarterly or annual filings, and they can have our division generate reports for doing bookkeeping, tax planning, and tax preparation in general, with more ease than having your payroll done somewhere else and just having them deal with third parties to acquire the information required to do your tax return. This provides an efficient and effective solution for many of our clients because it's all under one roof, and you don't have to be in a wild goose chase trying to get all your documentation together from one entity and another one, and just try to get it all together. Having it all together from the beginning actually helps a lot, and it's our clients really value all that.
Yeah, and something to add too, I mean, my personal experience, I've had plenty of times where clients have come to me to prep their tax returns, and all of a sudden they show me a brokerage statement with a huge gain on there that we didn't really anticipate for tax planning, and their investment advisor didn't really run that past the CPA or the accountant prepping the tax return. So it really kind of it makes planning harder when you don't have that open communication. I've also had some problems with some payroll reports too. Getting them from third parties. Oftentimes the payroll reports don't tie to the QuickBooks or the bookkeeping, so there's some major issues there where it's going to take time to fix those issues, and so it just makes sense to have everything under one roof and to be able to communicate openly to make sure everyone's on the same page too. So, all right. So before we jump into tax planning, small business owners need to first be informed of what taxes are out there and how these taxes can affect their businesses. I will briefly go over some of the more important business taxes we need to cover for tax planning. The first tax I want to cover is the income tax, which is a tax levied by a government directly on net taxable income. There is the federal income tax and the Wisconsin state income tax to be aware of. I'm sure everyone is aware of them. The income tax is based on the marginal tax bracket system, which generally means that as income increases, what is earned will be taxed at a higher rate than the first dollar earned. The marginal tax rate for an individual will increase as income rises. I will go through an example of this on the next slide so it makes more sense too. For sole proprietors, they file a Schedule F or a Schedule C and report their net income from the business on their Form 1040. Other flow-through entities such as partnerships and S corporations need to file a separate information return, Form 1065 for partnerships and Form 1120S for S corporations. These forms then generate a K1 for each of the owners so that they can report their allocated share of net income on their individual Form 1040. So that gets added to other income on the individual tax return. All the income is added up, less some deductions to get to your adjusted gross income. Then you have your adjusted gross income. You need to make a decision as far as if you want to itemize your deductions or take the standard deduction, and then you can then take your personal exemptions to arrive at your taxable income. The taxable income is used to calculate how much tax you'll actually have to pay, your gross tax that needs to be paid. If you make over a certain amount, the P's limitation needs to be looked at as well. If your adjusted gross income is over a certain threshold, your itemized deductions and your personal exemptions could be limited. So that's something to think about for some of those higher income earners as well. So for C corporations, they're really taxed on their own Form 1120 with their own marginal tax bracket with income not flowing to the individual owners. So they really they pay their tax, they file their tax on the 1120. It's not just an informational form, it's actually a tax that is going to be paid with the form that's filed. All right, so this is an example of how the marginal tax bracket works. On this slide, you can see the 2016 tax bracket for a married filing jointly tax filer. If this married couple had taxable income of $80,000, we would have $10,367.50 plus 25% of the amount over $75,300. The total income tax would equal $11,543. A common misconception that I've run into with some of my clients of the marginal tax brackets is that if you are in one, if you fall into one tax bracket, they seem to think that all of your income, your taxable income, is taxed at one rate, which simply isn't true. For this couple here, we have a portion of their income actually being taxed at 10%, 15%, and 25%. So they're kind of taxed at those different tax brackets. And obviously, as you can see in the tax bracket slide here, the more income you make, the higher the tax rate will be on that higher income. Something to think about too is capital gains tax rates. If for this married couple, if they had a capital gain and they fell in the 25% bracket, the capital gains would actually go on top of their taxable income. So a portion of their capital gains could be taxed at 15%. And the way that we get that is if you fall within the if you fall within the 10 or 15% tax bracket, your capital gains rate is 0%. If you fall between the 25% and the 35% tax brackets, your capital gains rate will be 15%. And then if you're in the 39.6% tax bracket, your capital gains rate will be taxed at the maximum of 20%. So 0, 15, and 20% are the capital gains rates that you can think about. I've had clients already come in this year to do some tax planning because they're really worried about selling. They had some property, they had sold it, and they had this huge capital gain that they were really worried about. And so they weren't really entirely sure how much they should pay for estimates. And so after we did a list of assumptions, we went through all the information, we did a projection, and we calculated out how much tax they would owe. And we also provided some additional tax planning strategies to really help them mitigate their tax. So we're gonna talk about that later on, but it's something to think about when you're doing a projection. Is you got to make sure you incorporate the capital gains tax rates as well, in addition to the marginal tax brackets. Let's see here. So on this slide, we have the corporate income tax brackets that C corporations can be subject to. Something to think about is C corporations need to also be aware of double taxation on their income and on the dividend distribution. So if they have net income that falls within that bracket there, they have to pay the tax rates on those brackets. And if they have any dividend distributions, then the owners need to make sure that they also pay tax on those dividends as well. All right. Another business tax that I'd like to kind of cover briefly here is self-employment tax, which is a tax consisting of Social Security and Medicare taxes for individuals who work for themselves, so self-employed individuals here. Generally, you must pay self-employment tax if your net earnings from self-employment was $400 or more. You are also allowed to deduct half of your self-employment tax on the front of your 1040. This tax is calculated on Schedule SE and reported on your individual tax return, and is also in addition to your income tax. So that's something to think about. Obviously, if your Schedule C business was making less than $400, then you wouldn't need to pay self-employment tax. Business owners with employees, or if they pay themselves as an S-Corp owner, they must pay payroll taxes as well as withhold payroll taxes from employees' wages and pay them to the U.S. Treasury. So if you do have employees, you need to make sure that there are employer FICA portion of taxes, and then you need to also make sure you're doing the withholding for federal withholding, state withholding, and then Social Security and Medicare withholding. So anytime you're hiring new employees, or if you don't already have a payroll and you decide you want to hire the first employee, you need to start thinking about how these taxes can affect your business operations. So, and they can have heavy implications there for how much tax you want to pay. Business owners need to also be aware of the sales and use tax in Wisconsin, which is a transactional tax that is charged by the seller on the sales price of retail sales of taxable services and tangible personal property. So if you're making a transactional sale that is subject to sales tax, you need to make sure that you are registered and that you collect the tax and then also remit the tax. That's something that it can get pretty complicated really quick if you're not entirely sure if the sale that you're making is subject to sales tax. So there's something that you probably need to consult with a tax professional and to really see if you're supposed to be paying the sales tax on a product that you purchase, or if you're supposed to be collecting sales tax on a sale that you have to a customer. So it's really important because you don't want to get audited under a sales tax audit and have to pay all these penalties and interest for not collecting and remitting the tax to the Wisconsin Department of Revenue. So briefly here, there's also if the business owns any real property, they need to make payments for property tax, and property tax is really a tax that's assessed based on the assessed value of the property. So it's another tax that you got to kind of take a look at. This is the final slide on business taxes before we get into tax planning. Alternative minimum tax. This is a minimum tax that must be paid by high-income taxpayers who took advantage of certain tax benefits by reducing their income tax. The tax does not allow certain tax deductions, and it reduces certain exclusions to ensure that high-income taxpayers are paying in a minimum amount. The tax is filed using Form 6251 and can often be very complicated to calculate if you don't understand it. When tax planning, it is important to consult your tax professional so they can incorporate this tax into the tax plan. As part of the Affordable Care Act, there were additional tax provisions on taxpayers who make over a certain amount. I will highlight two. The first is the net investment income tax, which is a tax that individuals, trusts, and estates must pay if their modified gross income is over a certain threshold. For married filing jointly taxpayers, and the threshold is $250,000, and for single taxpayers, the threshold is $200,000. The tax is equal to 3.8% of the lesser of the modified adjusted gross income over that applicable threshold or net investment income. The additional Medicare tax is 0.9% on wages, compensation, and self-employment income above certain thresholds. So the alternative minimum tax, the net investment income tax, and the additional Medicare tax really applies to the higher income taxpayers. If you're making over a certain amount, you need to really start looking at this to make sure that you fully understand your gross tax on your tax return. So there's definitely some implications here. Obviously, the net investment income tax, that is on your investment income. And your investment income includes interest, dividends, capital gains, rental and royalty income, non-qualified annuities, and other passive activities. So, and then your Medicare, your additional Medicare tax applies to Medicare wages and basically your earned income, your self-employment income. So definitely want to incorporate those taxes when you're thinking about doing a tax planning projection and trying to plan out what you want to do, or make sure you have enough funds at the end of the year to pay your taxes. So as you can see, there are many taxes business owners must be thinking about when tax planning. That is why it is important to plan what taxes will come into play and what you need to do to mitigate your taxes. Oftentimes it makes more sense for business owners to consult a tax professional so they don't get hit with a tax they aren't aware of.
We are now moving on to tax planning. Well, basically what tax planning is and what the process is. Tax planning is basically an analysis of financial situations from a tax perspective. And the process involves developing scenarios to create circumstances that are as tax efficient as possible. The process starts with a discussion of what the goals are for the business and the business owner. It is important to properly assess what the goals are so that we can effectively tax plan to reach those goals. Some examples of business goals that we would like to know about when tax planning are if the business is projected to have increased profits over the next 5 years. Before I continue, I'd like to stress the fact that a lot of people think that tax planning is only done for the next tax season, when filing their next tax return. And I mean, it is true, but considering the fact of planning, further ahead, to at least 5 for the next 5 years is actually really advisable. We try to encourage people to plan for at least the next 5 years and not just for the next tax season, their next tax return that they're going to be filing. So I just wanted to stress that. Continuing on the goals that we try to be aware of. Some of them are if there are plans for expansions to do business in a new area. And talking about new areas, I mean, if you're expanding within the state, that's all fine. But if you're looking at expanding to different other states, other regions of the country, going back to the different taxes that Kevin was talking about, you should also consider local taxes, because here in Wisconsin we get state tax. If you have an S corporation and you need to report payroll taxes, you have to withhold federal keep federal withholdings and state withholdings, but states like Indiana and other places, you also need to do local withholdings because there's an additional county tax or city tax. So that's something they should keep in mind as well. Now, we would also like to know if there are any plans to introduce a new product for their business, plans to purchase new equipment, or even plans to hire some employees. We also want to know the goals of the business owner to determine what the business owner is doing for retirement, and plans for operating the business in the future, and planning for succession of the business. And that's commonly overlooked. That's something people really don't think about. But it's really important to have a succession plan, because nothing is set in stone, and sometimes it's really difficult, not only for the tax professionals, for the CPA or the accountant to go through the process, but also for the people related to the business owner that are left with dealing with all the operations and everything. And there's not a succession plan, things are just way more complicated. So that's something that should really be looked at in depth.
Yeah, and something I want to add to, oftentimes when I'm talking to my business clients, when I'm asking them what their goals are, and they specifically say, well, they want the business to be obviously succeed and be successful and become profitable, and that's essentially their retirement. And I don't have any issues with that, but I do ask them if that's their only retirement, what happens if the business takes a bad few years? Are they going to have enough saved up for retirement? So it doesn't make sense to keep all of your eggs really in one basket when you're thinking of retirement. So just because you have one avenue for retirement doesn't mean you can't try to diversify and try to really mitigate your risk too. So it makes sense to look at some of these retirement plans to not only reduce your taxable income, but also really prepare for retirement, and really to plan for succession too. If you're ready to retire, who's going to take over the business? Are you planning on selling the business? Are you planning on having the next generation kind of take over the business? So those are some things that we really want to talk about, we want to think about when we do a tax plan. Again, we tax plan for multiple years, not just one specific year. So, all right, go ahead, Javier.
Thank you, Kevin. The next step, projecting out income and expenses. Well, basically, step number 3 is developing assumptions and making estimates to project out the income and deductions of the business for the remaining portion of the year.
We're on step 2, actually.
Oh yeah, sorry about that. We skipped a step. Tax planning. This is the step where we need to consider the financial statements of the business. Once we have a clear idea of the goals for both the business and the owners, We typically review the financials of the business, which show income and deductions year to date. The more accurate these financials are, the more accurate their tax plan will be. Typically, it makes sense to first review the financials to make sure accounts roll properly from the prior year, to make sure we catch any errors in bookkeeping. And this is important when doing bookkeeping. We were mentioning earlier that, you know, having your payroll and bookkeeping and all that stuff done by the same company that does your tax return is technically the best way you can go at it, because you know that if there happen to be any errors, they're going to be caught on time before actually filing your tax return and having then to file an amended return and going through the hassle of redoing your books. And that this is, you know, just another point on our favor and why you should have everything done by the same company. Now, moving from bookkeeping, we have to verify that bank accounts are reconciled properly, that liability accounts are tied out, and assets are recorded correctly with depreciation expense being tied out as well. It is especially important to keep track of receipts and expenses and file them away to substantiate the deduction in case of an audit. So yeah, just keep track of your records. That shoebox full of receipts and invoices. It sometimes it's a hassle to have to file all that away and keep that stored somewhere, but you really have to do it in case of an audit, because that's your get out of jail free pass. This step is definitely very important, as it is the starting point for where the income will be at the end of the year. This is how we start to create assumptions and start to forecast what we're going to be dealing with when we jump into step number 3.
And Javier, I just want to kind of jump in here. I've had plenty of times too, again, where some business owners, I ask them for their financial statements, and they do have, like Javier was saying, a shoebox full of receipts and whatnot. So oftentimes I will say, I will offer to organize all that for them. However, I think it makes more sense for them to come in and to have all that stuff already organized and totaled up and categorized into the proper income accounts and then the proper expense accounts. And not only for tax planning, but for the business owner themselves. I think it makes sense for them to know where they're at as far as the bottom line for the financials. And so even if they do have financials that come in, I do run into some common errors when I do review their books. And some of them I know Javier did mention, but I mean, it's really the payroll liabilities could be off. Perhaps the retained earnings doesn't roll from the prior period. Fixed assets really don't tie to the reports. The gain or loss on any assets that are being sold just aren't recorded correctly. Maybe there's some transpositional errors and other things that are really misclassified. For example, there are expenses that are hitting a repair and maintenance account that really probably should be capitalized in fixed assets. So those are some things that we need to really think about. If we do have large amounts, large expenses in miscellaneous expense accounts or even the repairs and maintenance account, it really could draw a red flag and perhaps get picked for audit. So we want to make sure we take a look at that before it gets to that point. And then also, again, I wanted to hit on the key topic of keeping your receipts. Try to keep your receipts at least 3 years. We always say 3 to 7 years or so. Just keep your receipts. Sometimes receipts, they don't really hold very well over time. A lot of times they fade. So it might make sense to actually get some of those like scanned in to make sure that you have some receipts to substantiate those expenses. So, all right, go ahead, Javier.
Yeah, and now that you mentioned that, I'd just like to highlight that tax planning is not just to lower your tax liability and mitigate your tax or try to fund or make bigger contributions to retirement plans. It is also done to avoid audits. And people don't really think about that, but the fact that doing a tax plan for whichever goals you have and doing it the correct way, it's also a very efficient form to avoid a tax audit, because that's the last thing everybody wants, to have to be audited and have to go through the process of all that. Well, moving on to step number 3, which is where, after we've done all the account reconciliation, gone through the bookkeeping and all of that fun stuff, we jump into developing the assumptions and making the estimates to project what the income is going to look like for the business, what it is now, what's going to be for the remaining portion of the year. These assumptions and or estimates will be based on the business owners' projections of business profits and what they believe the rest of the year will look like for when it comes to income. Now, we should have more of an accurate picture of what the current year will look like after we've done that. We can start to put some scenarios together for you to determine how much tax liability will be at certain levels of net income. If you want to purchase equipment before the end of the year, we can show you how that will affect your tax plan. We can even show you the consequences of selling investments and calculating gain or loss. This is important, going back to where Kevin was talking about capital gains, because you have to consider, maybe given the tax bracket that you're currently in, your capital gains are not going to be taxed, but that's not always the case, so we really need to plan for that. Now, when you want to do a contribution to an investment plan, contribute to a retirement plan, we can calculate the tax implications for you, how much you can deduct to be able to, how much can you contribute to be able to take it as a deduction, and how much after that you should be looking into contributing in addition, even though there's not a lot of a big tax benefit for the additional contributions. There's still a lot of things that need to be considered when you're talking about retirement plans. We can determine how much tax you're saving for every dollar that you're spending.
Yeah, and just want to jump in again. Really, for business owners, if they can kind of see into the future and see, well, how does this one transaction affect my tax return, this is the way to do it. This is the way that we can really project out the income. If they decide they want to purchase a piece of equipment or some property, how is that going to affect their tax return? If they make a contribution for retirement, or if they do decide, hey, what's going to happen if my income level in the next 2 months is going to drop dramatically? How is that going to affect my taxes? What if the next 2 months is going to be huge for my business? Maybe that's my busy season, and maybe I'm going to have a lot of income during those 2 months. How is my tax return going to look if I make $50,000 more than last year? So this is definitely a huge step as well, is really projecting out the income. And a way to do that is we do talk to the business owner. The owner needs to kind of give us an idea of how well they think they're going to do, or if they're not going to do very well in the next 2 months. So this is definitely a way to project out and kind of see into the future as far as what happens if they did a certain transaction, and how is that going to affect their tax return? So, okay, go ahead, Javier.
Well, we are jumping into step number 4, which is calculating the tax liability. So number 4 involves a tax calculation of liability based on taxable income under various scenarios that we come up with in our assumptions and estimates. So after we've done step number 3 and we have laid out different scenarios and different assumptions, this is when we start to see or try to forecast what the tax liability will be for each different scenario that we come up with. So by knowing how much tax is due on under each scenario, the business owner can effectively tax plan and determine what scenario is more appealing to them and more efficient from a tax perspective. So it's not just one option that we come up with or one option that we offer. We try to see different angles. We try to see and foresee all of the different aspects and kind of lay it out on the table for the client and see which one's more appealing to them, which one they think makes more sense to them. And then, of course, we'll have our professional opinion on it and try to talk them into what works best and is more convenient for them. Then we can also determine if the owner has paid in enough tax based on the scenario that we choose. If the owner should have paid in more for estimates, we can generate the voucher and get the payment sent in right away. Because even if they they pay their estimates on time, they accounted for a certain amount of dollars in tax liability, and after we've done tax planning and we come up with a scenario that fits all the aspects and needs, and we realize that the client ended up not paying enough for their estimates, we can just print the voucher and send an additional payment as voluntary payment, and that can always be done by the accountant. So moving to step number 5, which is developing a strategy. This is really a value-added service we at MBE CPAs provide to our clients. It's more of a consideration that we take for our clients. It's pretty much the process of developing tax planning strategies to mitigate tax and to pay taxes as efficiently as possible. When the tax planning, we don't just look at one particular year and tax them for that one year. And this is why I was talking about doing it for at least the next 5 years. We want to plan efficiently for multiple years so that you aren't stuck in a situation where you have a large sum of income that pushes you into a higher bracket one year, and then shifting things the next year. By keeping income equal over the years, we can effectively tax plan and maximize the tax bracket so that you aren't paying in more than you're legally obligated to pay. The business owner can see from step 4 what the tax implications are for making certain assumptions and estimates. And in step 5, we can show the business owner what we can do under each scenario to save them even more taxes and even provide some opportunities for the owner to reach their goals, not just tax-wise, but also their financial goals, because that's what we consider retirement plans and all that stuff. So the final step, step number 6, it pretty much allows us to discuss any changes to the tax plan throughout the year and adjust accordingly. If tax planning is done throughout the year and we keep updating the plan according to the situation of the business owner, and then at the end, once we have a more a clearer picture of what things look like, then we can adjust accordingly and do some tweaking to better benefit the client. Now, tax planning, timing.
I can cover that one, Javier. Oops. All right, tax planning. When should tax planning be done? It really can be done anytime you're interested in understanding the tax implications of a particular transaction. It is more commonly done before a large transaction, for example, purchasing expensive equipment or property, or even purchasing or selling a business. It is very important you tax plan with a tax professional, as tax laws can be complex and change frequently. I have had clients who have come to me after a transaction was actually completed, and they wanted to know what we could do to mitigate the tax consequences of the transaction. Well, after the transaction is actually complete and done, there is only so much that you can do as far as structuring the transaction to save in taxes. I'll kind of touch base more on this when I cover the tax planning strategies, but a lot of times it makes sense to consult with your tax professional before you get into a large transaction to make sure you understand all of the tax consequences of that transaction. It is also more common, like tax planning is more commonly done with maybe three or more months left in the year. It is often more advantageous to tax plan before the end of the year so that you can incorporate more effective strategies to reach the goals of the business owners. After year end, you can only do so much to mitigate your tax liability. So it makes sense to really look into this before the end of the year to really assess your tax liability and obligation.
Yeah, exactly. I'll just like to jump in and quickly just highlight that it is right. After year end, there's only so much you can do to mitigate your tax liability. It is really limited. You have really limited options once year end has passed, and some of the things that you can do, it's basically looking at retirement account contributions that could be applied to the year you're filing, and maybe do some recharacterizations of IRAs. But other than that, you should really think ahead and commit to a tax plan before year end. You're really gonna be in a better position doing it that way.
Yeah, and in order to really tax plan efficiently, your bookwork needs to be up to date. Like that's the only way that you can really do it efficiently and effectively, is if you have your bookwork up to date and accurate. A lot of times, some businesses don't have their financials ready until after year end, and by that time it's already too late. So that's why it's really important to stay up to date and make sure that your financials are accurate as possible. All right, tax planning strategies. Now I really want to go over the value-added material of the presentation, which is reviewing some tax planning strategies to mitigate your income taxes. Typically, in a high-income year, you would want to defer income and accelerate deductions, which will effectively push down your taxable income, resulting in a lower tax liability. And then I do have some options here as far as how you can defer some income. So really to defer your income, you may want to take advantage of like-kind exchanges, which allows you to trade in old property for new equipment that is of like kind that is used for the business. This allows you to really defer any gain or even loss on the sale of old property. So instead of actually selling the piece of equipment and having to realize any gain or loss, then you have then you can actually defer at least the gain. You want to defer the gain so you don't have to recognize any income. So if you're in a high income year, maybe you do want to sell a piece of equipment if you can realize a loss. That would make more sense. But if you would realize a gain, then it would make sense to do a like-kind exchange so that you could defer the gain further down the road, and then you still get your new piece of equipment. Next, before structuring a large sale transaction, you may want to consider structuring the sale as an installment sale, which means you will pay tax on the gain when you receive the sales proceeds and not during the year of the sale. There are some tax implications if it is not set up properly, so it is very important to, again, consult with a tax professional to make sure that this is set up properly. So you really can defer the gain when you receive the cash, so then you'll have the cash to at least pay the taxes. So that's definitely a great opportunity right there, instead of having to recognize the sale in the year of sale, recognizing that gain in the year of sale. So it's a good opportunity to really defer that income. You may also want to consider delaying billing on certain clients to ensure you won't receive the cash until after year end, and contribute contribute the maximum to your retirement account. Your total contributions to all of your traditional and Roth IRAs cannot be more than $5,500 for the year, If you are age 50 or older, you can contribute an additional $1,000. As you can kind of see here, you can contribute to the maximum under the respective retirement accounts on this slide. So this is a great opportunity to assist all the owners in lowering their taxable income, and also provides an avenue for funding their own retirement. So obviously you can kind of see there's different avenues here where they can actually defer more income by contributing more in, say, a SEP IRA versus maybe just a simple IRA. So something to think about, something that we can help out with. These tax planning strategies really help attract and retain valuable employees as well. So that's really something to think about if business owners have issues with retaining employees. It also obviously reduces the company's tax burden and allows you to invest in your own retirement too. So, all right, to accelerate your deductions in a high income year, you can take advantage of writing off tangible personal property you purchased in the current year. You are allowed to deduct up to $500,000 using Section 179, which can be reduced if you spend more than $2 million on property placed in service for the year. You can also take advantage of bonus depreciation to write off 50% of property purchased in the current year that is depreciated using the modified accelerated cost recovery system. Property with recovery of 20 years or less and original use must begin with the taxpayer. So it must be a new piece of equipment for the owner. To accelerate your deductions to acquire or produce tangible personal property, you can also elect the de minimis safe harbor election, which will allow you to deduct to the extent such amounts are deducted by you on your financial account purposes. You could deduct up to $5,000 per invoice or item if you do have applicable financial statements, or $2,500 per invoice or item if you don't have applicable financial statements. And an applicable financial statement includes a financial statement required to be filed with the SEC, as well as other types of certified audited financial statements accompanied by a CPA report, including a financial statement provided for a loan, reporting to shareholders, or for other non-tax purposes. You can also sell investments that you have a loss realized on, prepay state income taxes, as well as increase business deductions before the end of the year. It is important to take advantage of the home office deduction as well. If you have an area of your home that is exclusively used for the business, then you can deduct things like utilities, real estate taxes, maybe mortgage interest as part of your business expense. And that's apportioned obviously based on the area, square footage of your home. And the exclusive use has to be at least 95% used for the business and not for personal use. I think also you need to make sure you take advantage of any vehicle mileage that you use for business as well. Okay. Whoops, here we go. On the other hand, in a low income year, you would want to do the opposite and accelerate income and defer deductions. The main reason for doing this is to average your income over the years so you can maximize the tax brackets each year without having income being taxed at the next highest tax bracket. To accelerate income, a business owner can provide early payment incentives to get customers to pay receivables sooner rather than later. You can also try to close deals with customers before year end to get income in the current year. Business owners can also roll over traditional IRAs to a Roth IRA. You can also sell investments that will net income and gain. And then also to defer deductions, you can hold off on purchases of equipment or any other types of supplies or anything, and you can hold off on paying accounts payable until after year end, and make sure you don't prepay any expenses so that you can defer those deductions in maybe a higher income year. So there are plenty of other tax planning strategies that could be done. Again, it is important to consult with a tax professional to make sure everything is structured properly so that you can properly tax plan. Some other tax planning strategies include taking advantage of all of the deductions you are legally obligated to take or allowed to take. For example, you're allowed to take deductions like the domestic production activity deduction, self-employed health insurance deduction, and half of the self-employment tax. Going back to the domestic production activity deduction, it is really a deduction for businesses in the manufacturing sector. So although it can be a complicated calculation, it proves for many of my clients to be valuable in tax savings. The deduction is equal to 9% of income from qualified production activities, limited to 50% of wages paid to employees. So you need to make sure you pay wages to employees to take advantage of this credit as well. The self-employed health insurance deduction is sometimes missed on business returns, as it gets reported as an itemized deduction instead of on the front of the individual's tax return. If you have net income from the business, you are allowed to deduct self-employed health insurance to the extent of business net income. Health insurance, the health insurance you can deduct as self-employed health insurance includes medical insurance, dental, and even qualified long-term care. Some common deductions that I don't have on my slide that often get missed are state sales taxes and state income taxes, which can be deducted in the year you pay them on Schedule A itemized deductions. For multi-state entities or businesses, it is important to keep track of when and what state you pay estimates to, so we can get these deducted on the tax return properly. And that's something that can definitely get missed when tax planning as well. There are also tax credits available for that may actually be industry specific, which you may not be aware of. For example, if you have employees, you definitely should be looking at the Workers' Opportunity Tax Credit. The Workers' Opportunity Tax Credit is an employment tax incentive program sponsored by the federal government. It is intended to increase opportunities for people who have certain barriers to employment. The specific groups facing barriers to employment include veterans, ex-felons, food stamp recipients, supplemental security income recipients, and like long-term unemployed groups as well, just to name a few. Due to the personal nature of the targeted groups, a business owner might not necessarily know if they can qualify for this type of credit. So this is something that should be looked into, and oftentimes a third party can be hired to kind of assess the employees of the business. Another credit I want to touch on specifically for manufacturers and those in the ag industry for Wisconsin is the Manufacturing and Agricultural Tax Credit. This credit is available for 2016 at 7.5% of the eligible qualified production activities income, which has the potential to offset gross tax computed from the business operations. So that's definitely something that can completely offset your Wisconsin tax related to that business. There are credits available for businesses in certain industries, so I would definitely consult with a tax professional to make sure you're taking advantage of all of them. Another tax planning item to consider is making the S-Corp election. This election is not for everyone, but definitely an avenue for business owners to use to save on self-employment tax. When making this election, you need to be aware of the fact that you have to pay the owners a reasonable salary, which means you have to understand payroll taxes and making the deposits and getting your quarterly and annual filings done as well. So those are some other items that need to be considered. When tax planning, it is important to be up to date with new tax laws and regulations. If you don't do this for a living, it is very difficult to be on top of this. However, it can have major implications on your tax plan if you're not aware of these new tax laws. For example, the Fair Labor Standards Act contains new overtime rules that were actually effective December 1st, 2016. This new ruling sets the standard salary level at $913 per week, or $47,476 annually for a full year worker. The ruling basically says that if you have any employees that are salaried earning less than that and they were working over 40 hours a week, you need to pay them overtime or bump their salary to that new level. This ruling can have heavy tax implications for the business owners That is why it needs to be looked at right now. Business owners need to look at the new taxes implemented by the Affordable Care Act as well, to make sure they are compliant and paying the taxes if they are required to. So there's definitely a lot of items to really consider there.
Well, we are approaching the end of the presentation, and we have some scenarios that we'd like to share with you. Here at the scenario number one, this are actual scenarios from clients of ours, things that actually happened, we actually had to do, and we were successful at doing it. Scenario number one, well, the taxpayer was the owner of an insurance company. They were going to have an increase of income for that year of over $75,000. The strategies that we implemented were we told the client to we told him if you pay your final state estimate in January, it's going to be more advantageous than doing it beforehand, because he was going to be hit with the AMT, or the alternative minimum tax, which was not going to allow him to take that deduction. Also, the real estate taxes didn't really make sense to pay them on time that year, because the deduction wasn't going to be any good for him. So we had him just pay it on January and take it for the next year. However, we actually had him contribute towards the simple IRA to max it out, and the benefit of that was reducing the tax by 34.75% of whatever he was able to contribute. Bottom line, we ended up saving about $2,400 in tax in a $7,000 deduction. So what the final result was a tax payment. We minimized the tax payment by $6,400. The predicted federal AGI for this client was around $240,000. So paying estimates wouldn't benefit them at all, because they were hit with the alternative minimum tax. So that's why we encourage not to make those payments until the following month, which was January. And you don't really need any new equipment with an insurance company, so they needed to evaluate if they had the best retirement plans both for themselves and their employees. And scenario number two, in this situation, the taxpayer was the owner of a construction company, and income was going to increase significantly. He wanted to know how to offset some of the tax on that income, additional income. So the strategy implemented, we just told them, pay your final statement in December, don't wait until January. Take that deduction, pay your real estate taxes before December 31st, and take that deduction as well. And we recommend that you, this is the time for you to purchase some new equipment and have it ready before December 31st. By doing so, the client followed all three strategies. We were able to decrease their income by $17,000, which decreased their taxes by essence. It would benefit them more this year to pay their estimates in real estate taxes this year, because you're able to deduct them in the year that it's paid, as opposed to paying them in the following month, which wouldn't allow them to take that deduction. And the new equipment must be available for use in order to be a deduction. So this is really important. This is something that I like to make a highlight of. It's important to know the date of the purchase, but it's not as relevant and not as crucial as knowing the date that you place that equipment in service. For instance, equipment purchased in December 2015, but not placed in business or in service for the business until January of 2016 will be deductible until that following year. So even if you purchase equipment at a certain date, the actual deduction will be applied beginning the date that you place that equipment in service. That's something that you really have to keep in mind when accounting for equipment deductions.
Okay, to recap what we covered, it is important to set your goals for the business and the owners, to provide accurate financials year to date. Then we can project out income and deductions for the remaining part of the year, plan for different types of scenarios, so we can calculate tax, then come up with some tax planning strategies to maximize tax brackets and to provide a tax-efficient tax plan. So the process, there really is a lot that goes into the tax planning process. So it's really important to obviously stay organized, to really the timing before you do any large transactions. It makes sense to consult with one of your tax professionals or myself, and to really try to understand all the tax implications of that transaction. So really I think we had one question, which was how much can someone over 50 years old contribute to a simple IRA? And for 2015 and 2016, the maximum contribution if they're under 50 is $12,500, and then the maximum if they're over 50 is $15,500. And then again, that's for 2015 and 2016 for a simple IRA. So I hope you all enjoyed the presentation. I don't know if you have any other questions, feel free to contact us. I know we kind of went over our time. So we do have our contact information on the slide. So if you have any questions, shoot me an email or give me a call, or Javier, and we can help you out with that. I know there's a lot of, you can really get into specifics when you talk about tax planning. We wanted to kind of give you a general overview of at least the process, the different types of business taxes that are out there, and then give you some ideas for tax planning strategies. We didn't give you all of the tax planning strategies that we have, but those are some common ones that we typically like to use. So if you do have a specific transaction or a specific scenario that you'd like to give us, just let us know and we can try to assist you with that as well. So again, if you're interested in maybe more of an advanced tax planning course, just let us know. Maybe we can put something together more to tailor what you're looking for and maybe what other business owners are looking for as well. And also, if you're interested in our other webinars, please go to our website. So, all right, thanks everyone.
Thanks. I want to thank everyone for joining. And today like Kevin mentioned, we just wanted to have a general overview of what tax planning is and how it benefits people. And just to go over his words, if there's a specific situation you need to know more about, just don't hesitate to contact us, email, phone call. You can even go to our website and try to get some information from there. And just wanted to invite you to attend to the other webinars that we're going to be having. We're going to have QuickBooks webinar next Tuesday, November 8th. Wednesday, November 9th, we are going to talk about ACA, Affordable Care Act for businesses. And then on Monday, November 21st, we're going to do the Affordable Care Act for businesses again. And then on Tuesday, November 22nd, we're going to do the QuickBooks Part 2. So you're all invited. You're welcome to join us. And we are really glad that you attended to this webinar today.
Awesome. Thanks, guys.